Shares of Exxon Mobil, they are falling this morning. The world's most valuable company missed estimates. That is because of a slump in international refining profits. And on the phone now, joining us from Baltimore, is one of the most accurate forecasters around when it comes to Exxon. His name is Phil Weiss of Argus Research. He is a Bloomberg best because of that accuracy. Phil, just right off the bat, what's your feeling on these earnings? You'd think $100 oil is good for an Exxon, but apparently not in this case.
The earnings were okay. I know they were short. I tend not to get too wrapped up in what happens in any one quarter. Last quarter, they outperformed. $100 oil is generally good, but we just have to worry about if it has an impact on demand when it gets too expensive at the pump for consumers.
And have you seen evidence of that? Stephen Shork of the Short Group says you get gasoline to $4, it's a problem. What have you seen in your research?
Well, the demand, at least in the U.S., for gasoline is down at present. You know, when we look at it, the data that's reported on a look-back basis year over year, demand is falling some, but in other regions, some of the emerging economies, it's still up. So that it's not the best picture, but it's not the worst either, because it's kind of a mixed bag.
You know, I got to ask you, because there's something that I'm sure rubs a lot of people the wrong way. If you look at the price of oil in the mid-continent, at Cushing, Oklahoma, there's a lot of oil there, and it's significantly cheaper than, say, Brent, which is priced in the North Sea. That's the world oil. So if there's all this oil in the mid-continent and prices are cheap in the mid-continent, why is gasoline so high at the pump?
Well, the big problem that we have in the mid-continent is that there's pipelines bringing oil in. So oil's coming in from Canada because production from the oil sands has increased. And production from places like the Bakken Shale and the Eagle Ford, those places, they can all send oil in, but there's not pipelines that allow it to get out. So a lot of it's kind of trapped. And as long as that problem exists, that's why we have this very wide disparity between Brent and WTI. And that disparity is expected to stay in place for a while because it's going to take time to build pipelines to get the oil out.
Phil, I do want to ask you about ExxonMobil's results in particular, though, because the capital expenditures, according to a couple of the analyst notes I've read, seem to be growing faster than expected. Does that set any kind of precedent for the rest of the year?
Well, Exxon normally looks at their capital spending over a 5-year period, and they give us an estimate of what they're going to spend based upon that. Oil prices have been relatively high. As we know, profits have been relatively high, and cash flow has been good. So they're taking some more of that, likely, and redeploying it back into the business. So that means that they have the places to spend it, and it only bodes well for future production. So it's not, I don't view it as a bad thing to see spending, the capital spending go up. The only concern would be if it's too much inflation-based.
Okay, well, Phil Weiss of Argus Research, thank you, sir, for joining us.